welcome to the latest edition of Property Question Time with me, Gemma Forte. This is the show where you get to ask your property-related questions to a panel of experts from the industry. So without further ado, let me introduce you. First up, we've got Tony Gimple, who is the co-founder of Less Tax for Landlords. Hello, Tony.
Hi, Gemma.
And then we have Paul Mahoney from Nova Financial and James Jenkins from Money Sprite. Welcome all of you. Okay, I'm going to jump straight into some questions if that's okay, because that is, after all, what we are here for. So, Tony, starting with you. Somebody has written to us saying, looking at the rules about gifts, I see that you can give as many gifts of up to £250 per person as you want during the tax year, as long as you haven't used another exemption on the same person. Now, can this be gifts of actual money? Is there any reason someone couldn't do this once a month, say by standing order? Now, just a bit more detail. To explain the situation, her father would like to gift £3,000 a year to his 2 grandchildren. Okay? Can he get around this limit by separately gifting me and my partner multiple £250 as indicated above? So, Tony, what do you think?
You can give away as much as you like if it comes from normal expenditure out of income.
Okay.
So,
and is this related generally to inheritance tax?
It is.
Okay.
It is. Anything we give away during our lifetimes is a potentially exempt transfer. In other words, it stays in our estate for 4 whole years and 3 declining years for inheritance tax purposes.
Okay.
And there are certain amounts that you can give away totally free of tax. We each have what's called the nil rate band, currently worth £325,000. And if we own our own home and leave it to direct descendants, it's £100,000 in this tax year, rising to a further £175,000 from that within the next 2 years or so. So by the time we get to 2021, if you have your own home and are leaving it to direct descendants, you've got a total of £500,000 that you can give away free of inheritance tax.
Okay.
There's no inheritance tax between spouses or civil partners. In addition to that, you have what are called annual exemptions. There's a £3,000, £5,000 on the gift to children on marriage, etc., and an unlimited number of separate £250. You can also give away anything from excess income without incurring either immediate charges to inheritance tax or without it being this potentially exempt transfer. So, for example, let's say you're earning £60,000 a year after tax, you only ever spend 30 on maintaining your normal life. That other 30 can be given away without any inheritance tax consequences, providing it's regular, you can keep records of it, and in some circumstances that can also apply to saved income, but not investment income.
Okay, so in this person's case, they probably can gift that money and do it in different £250 chunks to different individuals.
But not to the same.
But not to the same child. Yeah.
£3,000.
Okay. All right then. Thank you. It is a bit of a minefield, isn't it? And of course, something that people are increasingly concerned about. Okie dokie. Right, Paul, let's go to you now. So this person says, I currently own my house with no mortgage. I don't have a steady income for health reasons. I live in East Yorkshire. It's always good actually to get this for context, isn't it? My house is worth about £175,000. Now, I've got savings of around £20,000, but is there a way I could borrow £140,000 against my house to get 2 properties locally worth about £70,000 and rent them out to cover it all? So basically, a buy-to-let mortgage with no income, but use my house as collateral.
Right. I think the main thing that needs to be clarified there would be how unsteady the income is.
Or they do say for health reasons that the income isn't that steady.
Yeah. So they've got a debt-free home, unsteady income, and it looks like they're looking to raise the money against the home, which would make it a residential mortgage rather than a buy-to-let mortgage. The main way that residential mortgages are serviced is through income.
Of course.
So the thing that the barrier they'll probably run into there is the fact that they don't have the steady income, and that most lenders will lend you 4 to 5 times your income, but they want you to have a steady income. So, depending on how steady it is will probably determine whether they can borrow or they can't, and how much they can borrow.
So if they just explained to the bank, look, if you lend me this, I could have some income because I'd buy these properties, that's not going to happen.
Well, in 2007 that might have worked.
Right,
That doesn't work anymore.
Yeah, things have tightened up so much.
So most lenders will want you to have 3 months of steady income.
Yeah.
If you're employed, or if you're self-employed, 1, 2 or 3 years of accounts.
Yes.
To give them comfort that that you have that income to actually service the mortgage.
And from the bank's point of view, is that because they'd be worrying like, well, your business idea might not work, it might not be valid?
So it's just about being able to service the debt.
Yeah.
Because your income is the way that you do that.
Yeah.
Thinking outside the box a little bit, maybe getting a guarantor involved or something like that might sort of open up some options for them.
Yeah. You can see how they're thinking. They're thinking, well, I've got this capital sat there. If you just had that as cash in the bank, you'd be able to use it. But of course you can't. Yeah. Then if they can't, they've got health reasons. I can understand the thinking of trying to make that property work for them.
Well, I think, as Paul said, I think the key there is separating what they want to do with the money and where the money is secured now, because they could, in theory, they can get buy-to-let mortgages on new properties without that steady income, because that's going to be based on the rental income of the property. So if they wanted mortgages on 2 other properties, rented out for those purposes, that's not so much of an income on the on the personal income side of things, because lenders lend on that basis.
Right.
The fact is, the money that they want to borrow to be able to give them the deposits is going to be on a residential property and is purely based on their income. So irrespective of what he wants to do with it, that's not going to be impacted by what he wants to do with it, if that helps. Yeah, on the income side of things that Paul mentioned, lenders want regular income. They want 3 months pay slips if it's employed, and it depends how regular and what they're doing. So if they're saying they're working job here and there, that's going to be an issue. The only thing they could do is potentially, if they're getting government benefits, maybe for the income, if they're getting for the illness, subject to that not equaling more than what his personal income is, you could use that to bolster up his income. So there may be something. Yeah. I'd say it sounds relatively unlikely from what the guy's saying, but speak to a financial advisor and see what you can come up with.
And I guess these are the kind of conundrums that all three of you in your professional lives face when people come and they're like, what do I do? So yeah, very interesting. Okay, thank you for that. And James, a question for you. So this person says, I live in a share of freehold flat with a mortgage and it's in my sister's name. The original mortgage agreement was with both of us. We remortgaged some years ago as it was cheaper for her to be the sole person on the mortgage. I was a student at the time. She subsequently moved out. Are you following? Yeah.
I think so, yeah.
And some of these are like brain teasers. And I've remained at the property since. When my sister moved out, we didn't inform the lender, and I've been paying the mortgage during this time. So we're now in a position to fully pay the mortgage and intend to do so, but my questions are this. Should I have informed the mortgage company of this arrangement? What will happen if I inform them? Would I be penalised or fined? What are the consequences of not having informed them?
It's quite a grey area question.
Yeah, I was thinking, if the mortgage has been paid...
Well, it comes down to whether the lender's aware that the person living in the property is not the mortgage owner. So... a bit weird because they bought the property together initially and had the mortgage together. Yeah. And I'm sort of intrigued as to why they would have come off that mortgage.
I'm a bit confused about. Yeah. Why change it?
Yeah, why you would have come off it. Now, at that point, because the client has lived at the property, they've accrued rights on the property, they owned it. For them to sort of stay living there but be removed from the mortgage, what should have happened at the time would be they would have sort of signed a consent to mortgage form or did a consent to say that they waive any rights on the property, that they can stay there. So basically, if the lender wants to repossess, they can kick this person out because their debt is with that mortgage holder. Yeah. So it'd be interesting to see whether that was done first and foremost, because actually if they've signed a consent to mortgage, therefore the lender is aware that that person is living there. Whether the person's got the mortgage or not, is living there or not, is kind of irrelevant. Yeah. They're aware this person is living there. The second part is most lenders will allow them to leave a family member living in a property, subject to signing a consent to mortgage, as long as they haven't signed up any, it's not a tenancy agreement, it's not under an AST agreement, and that they're not paying rent for that. So the fact they're paying the mortgage is okay, but it's not rent and it's not an AST, which would again give them rights as a tenant in the property. If they're selling the property now, there's no real reason to go backwards and explain what had happened, I would have thought, because it's being sold, the mortgage is going to be repaid. Yes, they should have told the lender that he was living there,
Right.
but therefore if they know that he's living there, it's not so relevant that whether the other one's there or not, if that makes sense.
Okay.
As long as the lender knows who is living there,
Yeah.
and that their right as a lender to repossess is protected by the deed of consent.
Yes, okay. So essentially it's a bit of a sort of, you know, looking back, like, oops, should I have told them? Am I going to get into trouble now? But
You should always communicate with the lender with
Yeah.
anything that changes. So
Yeah.
would it have been good practice? Yes, it would have been good practice.
yeah,
As long as they've done that consent and the lender, when they borrowed the money in the sister's own name, was aware there was a third party going to remain in the property, then this shouldn't be too much of an issue. It's
Yeah.
whether it was done back then.
Yeah.
But the main thing is if it's going to be sold.
okay. Is this going to crop up when I start charging my kids rent to live with me? Which is, I mean, they're 12 and 11. I'm thinking it's quite soon, yeah.
That's actually quite relevant in that once children over 17, is it? They do need to sign a consent to consent to mortgage.
Consent to mortgage or
Yeah.
deed of consent, they call
Yeah.
it different things.
to waive their rights to the property.
Really?
Yeah.
Yeah, 'cause
My
once-
kids could squat in my house and take it from me. I love that.
yeah, so if you didn't pay your mortgage, they can't get kicked out. And that's
Oh,
that. Unless you
really?
sign a consent to mortgage, yeah.
Extraordinary stuff. Well, thank you. I'm going to be very wary of that. My kids are quite shrewd. And you just never know what they might be
I've
planning.
been Googling it already.
Yeah, exactly. Have you got anything to add, gentlemen, to what James was saying?
No, I don't think so, other than if circumstances do change, seek professional advice. It doesn't always end up with a bad result.
No, and I think this is the thing, is when you're doing things like this with family, it's so easy, isn't it, to make arrangements amongst yourselves, like, oh, well, I'll cover that for a bit, or I'll cover that, but actually you forget that if that was another individual, it would become much more formal.
I think the main thing is how it worked when he came off that mortgage, what was done legally then.
Okay, all right. Well, thank you so much, and that's it for this half of Property Question Time, so join us for more wisdom and pearls of knowledge after this short break. Hello and welcome to part 2 of Property Question Time with me, Gemma Forte, and my 3 guests, Tony Gimple, Paul Mahoney and James Jenkins. Right, we are now going to dive in for a golden nugget. Now, this is where you get a piece of advice that you'd pay thousands for, quite frankly, and you get it for free. Paul?
Well, I suppose knowing your limits when it comes to property investment, or knowing what's suitable for your skill set. Increasingly, I'm seeing people that are just sort of rushing into property development or renovation projects when it's not something they've ever done before. Right. They might watch Homes Under the Hammer, or they might attend a day-long course where they can see they can recycle their money really quickly and make 100 or 200% profits, and it all looks really easy. But property development is a profession. It's a business. It's something that people do for years and years, learning, doing it for other people, and then maybe one day they'll go out and do it for themselves. You don't do a day-long course and start doing brain surgery,
I hope not.
So, I suppose respecting what actually goes into that process and the skill sets that's required. And I suppose, if you're a first-time investor, then you should really be starting out very passively.
Yes.
And building your knowledge and your skill set in that area, and then potentially building up from there, but not sort of chasing the hype of these massive returns that you can make overnight in something that you really don't know anything about.
Yeah, I think you're so right, and a lot of those programs are not to blame because they sort of inspire people, but sometimes, as you say, suddenly I am a property developer. Well, not necessarily, or it's like anything though, isn't it? I wouldn't suddenly start a florist because I don't know anything about flowers. So yeah, that's really good advice, and I think so start gently and learn.
I think a lot of the success stories that you hear, there's just as many failure stories, probably even more failure stories that you don't hear about.
Yeah, and you do see some of those on property programs as well, don't you? People suddenly like up to their eyes in this sort of leaky, terrible place where they're trying to do their bit of DIY. And yeah, you're like, oh, that looks quite stressful. Thank you. Right, we're going to go to James now, and this person has written in to say, I am right in the path of Ophelia. So this has come in from overseas and it's beginning to hit hard. If this is only the beginning, then I can see there being a lot of damage I've been told by a friend that home insurance won't cover this as it's a natural disaster. So obviously we've had Ophelia now. That's happened. But going forward, if there are ever more hurricanes, this is a pertinent question. Would their home insurance cover a natural disaster?
Okay, well, yeah, home insurance policies will vary from provider to provider. Natural disasters are usually, when they're talking about home insurance, are sort of linked to, or in insurance terms, things like earthquakes and tornadoes, that sort of thing.
Yeah, all that floods.
Floods, that, and sort of areas that are potentially more prone to that. So have you bought a house on a fault line, for example, which luckily we don't have too many of those in the UK.
No. It can get quite windy though, can't it?
It can do. Now, most insurers will cover storm and flood damage. I guess it depends on what the record of claims are in that area. Okay. Have they previously had lots and lots of claims for it, and therefore is that home prone to it? You need to obviously check the policy carefully for what it is going to cover you for, storm and flood, or if it's natural disasters. Most often insurers will pay out for things like, one-off kind of
trees falling on your house.
Trees falling on your house, a lightning strike, that kind of thing. But they can sometimes use something called the Act of God clause, and they use that to kind of get out of it. If it's an act of God, that's not covered. I think there was a story once, not too long ago, of a woman trying to sue God for $89,000 because they had a lightning strike, failing to control the weather adequately, apparently. So
did he show up?
I don't know how it played out, if I'm honest with you. I think he didn't turn up at court, and they ruled in his favour. But that said, it's very, very important to just check the specific terms. And it comes down to when you buy that policy initially, making sure you don't go for the absolute cheapest one when you look online or wherever you go and going, well, that's cheaper than that one, so it's going to do the same job. They don't all do the same job. Make sure you get the policy right in the first instance.
Yeah, the policies vary greatly. So understanding the policy that you have will answer that question, really.
Yeah, you see, I'm going to admit that when I'm talking, I get a bit bored and then I just go, that one. And and I'm sure there's lots of other people like me as well. And I kind of wish sometimes it was a bit easier when it was being explained. Sometimes there's too much small print and T and C's and everything. And I just want to know, what am I covered for?
Well, you're absolutely right. A lot of times, and people search on the internet, they will go for, and they'll just treat every policy, it's all the same. Same with car insurance, it's all the same. Well, no, every insurance policy is different. And there is usually a reason why. The cheapest there, that's £100 a year cheaper than everything else, is cheaper for that reason, and it's likely to be due to the claims payout records. Right. So it's important, as with every kind of insurance really, is take proper advice about it, tell them what your concerns are, and then make sure they find the policy that's right for what you're concerned about.
Thank you, James. Okay, moving along to Paul. This person says, I want to buy a property to rent out as an investment. Why do I need a buy-to-let mortgage? Can't I just get a normal mortgage and rent the rooms out?
Okay, you could. You'd have to make sure that your lender would accept it.
Yeah, would that be illegal?
It wouldn't. It's not illegal. You would have to live there, though. The residential mortgage is a property that you live in. It's your primary place of residence. You can't have two residential mortgages. Yeah,
so they're saying they want to rent it out as an investment.
So if they're not going to live there and they're going to live elsewhere, then they need a buy-to-let mortgage. If anything, buy-to-let mortgages are easier to get than residential mortgages. So I'm not quite sure why they'd prefer to have a residential one. But the answer would be just get a buy-to-let mortgage. It's a buy-to-let property, and that product is specific to that type of property.
What would be the consequences of getting a normal residential mortgage and then you've got 3 people in who are putting money into your bank account every month as rent?
Well, you can get consent to let. You know, for example, if you own a home in a certain area and you move to another area to work there and you're renting elsewhere, you can rent out your property with a residential mortgage on it so long as your lender allows it. So essentially just ask for their permission and they'll generally give it to you.
But say you didn't, is that illegal?
Well, it would be breaking the terms of the mortgage. So technically they could recall the mortgage if they wanted to.
Yes, it's just not worth it, isn't it?
No.
No. Tony's no. Okay, so get the correct mortgage for whatever it is that you're doing. And as you say, getting a residential mortgage is on your earnings, isn't it? And getting a buy-to-let mortgage is on the basis of the property.
Generally, people try to do it the other way around, what they call a backdoor buy-to-let, where someone will already own a home, they'll buy a buy-to-let property that might be beyond their affordability range and actually go and live there. And that's something that lenders are really conscious of now.
Oh, right.
And in fact, lenders will even look at where this buy-to-let is in proximity to your work. And if it's closer to work than your current home, that's something that will be a red flag. So you need to be a bit conscious of that.
Oh, that's interesting. I did not know that. Okay, so they're not stupid, are they? Eventually they find out everybody's little...
Lenders are very, very hot these days on post-completion checks. So they're doing things like electoral roll checks and just general checks on who is actually living at a property they've done a mortgage on. So if you've got a buy-to-let mortgage where you're showing up as living there, you've got problems. If you've got a residential mortgage where you're not showing as living there, someone else is, you've got problems. Yeah. So it's just the propositions are there. Residential works for residential, buy-to-let works for buy-to-let, and then you're going to be fine. If you want to rent it out, get a buy-to-let mortgage.
And lenders share information as well. So you might think that you're okay because you're not telling that particular lender something, but they might find that out from another lender.
The system is sufficiently free, fair, competitive and commercial that you don't have to hide these kinds of silly things. There are plenty of people out there who will look at the business case, and if it stacks up, very happy to lend you the money.
I mean, partly this is because, of course, many banks got such a bad rep at one point, didn't they? So it's not, all just because they're so wonderful. It's because they need to now protect their reputations, don't they? They need to make sure everything is legitimate.
And there's plenty of products that are fit for purpose.
Yeah.
So you just use the one that works for your situation.
Yes.
You don't have to game the system.
Okay, I won't then. Okay, thank you. Right, Tony, finally a question for you. It's a good one. You probably might all want to pitch in. What does it take to run a professional property business? This is a bit interesting, actually, because it's a bit like going back to your golden nugget. Yeah. There is a big difference, isn't there, between a very professional property business and just sort of someone who thinks, oh, I'll have a go at that.
I think the key is making a decision that I'm going to run a business. I'm not going to be a landlord. I'm running a property business, and as such I would run it on the same lines as any other business. TV company, professional practice, developer, corner shop, immaterial. So you've got to look at how much you're prepared to invest, what that money will buy, what return you're looking for it, what is your raw material, in this case renting property. Is it sustainable? Is there demand? All the things that any business would look at. The fact that you're now, owning property as opposed to selling glasses, it's exactly the same process.
Yeah.
People think it's easy. Well, neither being a landlord nor running a professional business is easy. It's damned hard work. They need to be able to accept they don't know what they don't know. They need to be prepared to pay for advice, because it's a really broad subject. It's not just being a landlord, being a property owner. It's legals, financials, tax, maintenance, insurance, vetting.
Yeah, whereas I think some people think it's choosing a nice paint colour for the front door.
That's part of it. Having the right brand, making a curb appeal and making the place fit to live, so somebody walks in and says, well, I want to live there. That's also part of the business, but not just.
I am quite good at that bit. But I go to people like you for everything else.
I think the bigger part of that question is really, really topical. From the 1st of October this year, 17, the Prudential Regulation Authority rules changed on buy-to-let mortgages. Effectively, lenders are now looking at you as a business.
Right.
You've got to have a business plan.
So it gets more and more difficult to make money these days, doesn't it?
No.
There's less of it about, and it's more and more hard to make money.
No, it's not.
No,
it's not. You just got to be more determined and do it the right way to start with, as opposed to just taking a chance.
Yeah.
Know what you want to achieve to start with, and work
is that
out.
because partly because there's less affordable housing for people getting on the property ladder, and they don't want people who've already got property getting more property? They want to allow the lower end of society to try and get on the, or just normal people to get on the property ladder.
It's really not a class thing. In part, there is more demand for housing than there is supply. Our children are leaving home.
Yeah, and it isn't a class thing, absolutely not. It's across the board. You can get You know, everybody, it's difficult. I was listening on the radio the other day, and there was a couple, they worked really hard, and they had a percentage of their savings, very determined people, always put away every month, which a lot of people don't do, and they'd saved up something like £15,000, and he was saying it's so depressing. I just still nowhere near getting a home, but that's a lot of money to save. It's a lot. So yeah.
I think Tony's point is right, and what you're saying is that the reason, or a lot of the reason why the regulations have come in and changed, is because that's the kind of underlying thing to it, is we want to make sure that people aren't buying lots of properties and people who need them can buy them. But I think what it does with the regulatory change with the PRA, and a lot more around portfolio landlords, is that actually there is still plenty of money you can make from doing it, but actually I think you'll find it's people now who are more determined, focused, and actually have that proper plan in front of them as to how they're going to get there, because the real quick returns for Mr. and Mrs. Smith playing at it are kind of chipping away, and more, and once you've got sort of more than 4 properties, it's starting to get harder and harder to get the finance because you're now portfolio lending. So you've really got to decide when you're looking at it what kind of buy-to-let business is this going to be, and if it's going to be a proper business, then sit down and talk to the people properly about the tax and so on and so forth, and then the money is still there to be made, but probably I guess more longer term and more well planned than maybe what you could have done previously.
Being more and more professionalised, and that, I think that's the the big reason for a lot of these changes recently, is that they don't necessarily want people having a property here and there. You know, exactly what Tony said, people actually doing it properly. And to do it properly, you do need to surround yourself with the right team.
You certainly do, like I have today. So thank you so much to all of you. James Jenkins from Money Sprite, Paul Mahoney from Nova Financial, and of course Tony Gimple from Less Tax for Landlords. Thank you so much for watching. I'll see you soon.